What happens when three empires start crumbling at the same time? Right now, as I'm recording this on January 10th, 2026, we are witnessing something that happens maybe once a decade. Iran is burning. Russia just fired a nuclear-capable missile 45 miles from NATO territory. The UK is threatening to ban one of the world's largest social media platforms. And somehow, the stock market just hit another all-time high. In the next 40 minutes, I'm going to break down 10 seismic events that happened in just the last 48 hours. Events that are reshaping everything from oil prices to semiconductor stocks to precious metals. We've got Trump meeting with oil executives about $100 billion in Venezuelan investment. Intel stock exploding 10% after a White House meeting. General Motors writing off $7.6 billion on their failed EV bet. But here's the thing that keeps me up at night. These aren't separate stories. They're all connected. And if you understand how they're connected, you'll understand exactly where the money is moving in 2026. Let's get into it. Let's start with the biggest story that mainstream media is barely covering. Iran is experiencing its largest protests since the 1979 revolution, and the regime just went dark. On Thursday night, January 8th into the 9th, the Iranian government did something unprecedented. They didn't just slow the internet. They didn't just block certain apps. They cut off everything. Nationwide internet blackout. International phone calls. Disconnected. The entire country of 87 million people was essentially sealed off from the world. And here's why that matters for your portfolio. According to the human rights activist news agency, at least 65 people have been killed since the protests began on December 28th. CNN is reporting eyewitnesses describing bodies piled up on each other in hospitals. Videos leaked through VPNs show massive crowds in Tehran, Mashhad, and Yazd, chanting not just against the economy, but directly against Supreme Leader Khamenei. The protesters are chanting, "Death to the dictator." They're waving the lion and sun flag, the flag of the Shah, the monarchy that was overthrown in 1979. This isn't just economic protest anymore. This is regime change talk. Supreme Leader Khamenei went on state television Friday and called the protesters vandals and saboteurs. He accused them of ruining their own streets to make the president of another country happy, referring to Trump. Iran's judiciary chief then promised punishment that will be decisive, maximum, and without any legal leniency. Iran's judiciary chief then promised punishment that will be decisive, maximum, and without any legal leniency. But here's where it gets interesting. And here's where the speculation begins. Trump responded to Khamenei directly. He said, and I quote, "Iran is in big trouble. You better not start shooting because we'll start shooting too." That's not diplomatic language. That's a warning. And it comes just 1 week after the U.S. captured Venezuelan President Maduro in a military operation that nobody saw coming. Now, foreign policy is running headlines asking, will Iran's protests finally topple the government? The Atlantic says Iranian officials are in survival mode. And remember, in June 2025, the U.S. and Israel conducted joint strikes on Iranian nuclear sites. Iran's missile forces were damaged. Their regional proxies, Assad in Syria, Hezbollah in Lebanon, have been shattered. The Iranian rial has collapsed to 145,000 to the dollar. Inflation hit 42% in December. The Grand Bazaar of Tehran, historically a bastion of regime support, has shut down in solidarity with protesters. So what does this mean for markets? Iran produces roughly 3 million barrels of oil per day. If this regime falls, or even if it faces prolonged instability, you're looking at potential oil supply disruptions at a time when the market is already watching Venezuela. Energy stocks, defense contractors, precious metals, all of these have geopolitical risk premiums baked in. Here's my speculation. Trump is positioning for something. The Venezuela operation was a test. The oil executive meetings are ongoing. If Iran's regime continues to crack, we could see a very different Middle East by summer and a very different oil market. Speaking of empires trembling, let's talk about what Russia just did. On Thursday night, January 8th, Russia launched its second ever Oreshnik missile strike on Ukraine. This is a hypersonic, intermediate-range ballistic missile that Putin claims travels at Mach 10, 10 times the speed of sound, and is unstoppable by any air defense system. The target? The city of Lviv in western Ukraine, 45 miles from the Polish border, 45 miles from NATO territory. Let me say that again. Russia just fired a nuclear-capable missile that landed 45 miles from a NATO ally. The EU's foreign policy chief, Kaja Kallas, called it escalatory and unacceptable. She said the strike was meant as a warning to Europe and to the US. Ukrainian Foreign Minister Andriy Sybiha has demanded an emergency UN Security Council meeting. This was part of a massive barrage, 242 drones, 36 missiles total. At least 4 people were killed in Kyiv. Half of the capital's apartment buildings lost heating in the middle of winter. The Oreshnik itself reportedly struck an underground natural gas storage facility. Now, here's the context that matters. Russia just stationed Oreshnik missiles in Belarus. On December 30th, they announced a battalion had begun combat duty there, right on NATO's eastern border. This is the first time since the Cold War that intermediate-range nuclear-capable missiles have been deployed in Belarus. And this strike came right after the Coalition of the Willing meeting in Paris, where European nations discussed deploying peacekeeping troops to Ukraine after a potential ceasefire. Russia's foreign ministry called those peacekeepers a legitimate target. So what's the market reading here? Defense stocks are already pricing in this escalation. The $1.5 trillion U.S. military budget proposal is moving through Congress. European defense spending is accelerating. But here's the speculation. Trump is caught between two impulses. His desire for a deal with Putin and Putin's apparent unwillingness to make any concessions. If peace talks stall and this escalation continues, you're looking at sustained defense sector strength, potential energy disruptions in Europe, and continued safe haven flows into gold. Now let's talk about something that sounds like fiction, but is absolutely happening. The President of the United States is threatening military action against a NATO ally. On Friday, Trump told reporters at the White House, and again, I'm quoting directly, "We are going to do something on Greenland, whether they like it or not. Because if we don't do it, Russia or China will take over Greenland, and we're not going to have Russia or China as a neighbor." He added, "I would like to make a deal, the easy way. But if we don't do it the easy way, we're going to do it the hard way." Denmark's Prime Minister, Mette Frederiksen, has warned that any U.S. attack on a NATO ally would be the end of everything. The 5 political parties of Greenland issued a joint statement saying, "We do not want to be Americans. We do not want to be Danes. We want to be Greenlanders." Secretary of State Marco Rubio is scheduled to meet with Danish and Greenlandic officials next week. But here is the critical detail that CNN reported. Neither Trump nor anyone in his administration has ever directly raised the idea of purchasing Greenland with Danish or Greenlandic officials in private. All of this is public posturing. So why Greenland? Why now? Greenland sits on massive rare earth mineral deposits, critical for semiconductors, EVs, and defense applications. Its strategic location in the Arctic is increasingly important as ice melts and new shipping lanes open. And Trump sees it as part of a broader hemisphere-first strategy following the Venezuela operation. Here's the speculation. This is negotiating theater. Trump wants concessions, mineral access, basing rights, investment deals. The threat of military action is leverage. But the damage to NATO cohesion is real, and European defense stocks and ETFs are pricing in the possibility that the U.S. might not honor Article 5 commitments. All right, let's pivot to something that actually moved stocks this week. On Thursday, January 8th, Intel CEO Lip Bhutan met with President Trump at the White House. Afterward, Trump posted on Truth Social, "I just finished a great meeting with the very successful Intel CEO, Lip Bhutan. We made a great deal, and so did Intel. Our country is determined to bring leading-edge chip manufacturing back to America, and that is exactly what is happening." Intel stock jumped over 10% on Friday, closing at $45.55. The U.S. government now holds a 5.5% stake in Intel, worth nearly $20 billion after this rally. That stake was purchased at $20.47 per share, so the taxpayers have nearly doubled their money in less than 6 months. But here's what's really interesting. Just a few weeks before the government's $8.9 billion investment was announced, Trump was calling for Tan to resign over alleged conflicts of interest. Now he's praising him as very successful and calling Intel a national champion. What changed? Intel announced at CES this week that it began shipping its first sub-2 nanometer 18A products on schedule. These are the first chips at this advanced process node that are designed, manufactured, and packaged entirely in the United States. This is the kind of technological independence that the CHIPS Act was designed to achieve. The semiconductor story in 2026 is all about localization. TSMC in Taiwan faces geopolitical risks. China is under export restrictions. And now you have the US government literally invested in Intel's success. NVIDIA and SoftBank have also taken multi-billion-dollar stakes in Intel. The Tan turnaround is becoming a real investment thesis. Here's my speculation. Watch for additional government contracts, potential tariff protections for domestic chip production, and continued stock appreciation as Intel proves out its manufacturing capabilities. The Trump administration wants to showcase this as an industrial policy success story heading into the midterms. Now for the other side of the industrial coin, General Motors just announced a $7.6 billion write-down on its electric vehicle business. Think about that number for a second. $7.6 billion, that's more than the entire annual GDP of some countries. And GM is essentially saying, our bet on EVs didn't work. The charges include $6 billion related to scaling back EV production and about $1.1 billion for restructuring their China operations. This follows a $1.6 billion charge announced in October. Ford already took a $19.5 billion charge for the same reason in December. What happened? The $7,500 federal EV tax credit ended in September 2025 when Trump terminated it. California's gas car ban was rolled back. EPA emission standards were relaxed, and consumer demand for EVs, which was already softer than projected, collapsed in Q4. GM had been the most aggressive U.S. automaker on EVs. They pledged $27 billion in investments. They planned for more than half their factories to be EV capable by 2030. Now they're canceling supplier contracts, idling battery plants, and laying off workers. The GM stock dropped almost 3% on Friday. But here's the bigger picture. This is a massive rotation in the auto sector. The EV transition narrative that dominated 2021-2024 is over. Traditional gas-powered vehicles are back in focus. Oil demand projections are being revised upward, and companies like GM are going to pivot back to what actually sells. Stellantis also announced Friday they're phasing out plug-in hybrid programs in North America, starting with the 2026 model year. For investors, this is a sector that's going through fundamental repricing. Some legacy automakers may actually benefit from the EV pullback as they return to profitable ICE production. But the supply chain, battery makers, charging infrastructure companies, raw material miners, is going to see continued pain. Let's talk about something that could reshape social media and AI regulation globally. The UK government is threatening to ban Elon Musk's X platform entirely. Prime Minister Keir Starmer called the situation disgraceful and disgusting, saying X needs to get their act together. What happened? X's AI chatbot, Grok, has been used to generate non-consensual sexualized images, including of children. Users could upload photos and ask Grok to remove clothing or create explicit content. High-profile targets reportedly included Kate Middleton and various journalists. The UK's internet watchdog, Ofcom, has confirmed that Grok-generated images have already appeared on the dark web as illegal child sexual abuse material. Under the Online Safety Act, Ofcom can essentially ban X by ordering internet service providers and app stores to block it. Musk responded by restricting Grok's image generation to paid subscribers only. But the UK government called this insulting, saying it just turns an AI feature that allows the creation of unlawful images into a premium service. Musk then posted that critics want any excuse for censorship, and shared AI-generated images of Keir Starmer in a bikini, saying they just want to suppress free speech. Multiple countries are now investigating: India, Malaysia, Indonesia, France. Some are threatening their own bans. Here's why this matters for markets. First, this is a test case for AI regulation globally. If X gets banned in the UK, it sets precedent for how governments can respond to AI-generated harmful content. Every AI company is watching. Second, Musk's political role creates complications. He's a close Trump ally. The Trump administration has already expressed concerns about the UK's Online Safety Act affecting American tech companies. This could become a transatlantic diplomatic issue. Third, advertising revenue. If major markets start blocking X, the platform's economics get much worse. And remember, Musk still owes banks about $13 billion from the Twitter acquisition. On Friday, Trump met with more than a dozen oil company executives at the White House, including the CEOs of Exxon and ConocoPhillips, to discuss investment in Venezuela. The headline number, $100 billion. That's what Trump says oil companies will spend to rebuild Venezuela's energy sector. Remember, Venezuela has the largest proven oil reserves in the world, 303 billion barrels. But production has collapsed from 3.5 million barrels per day to under 1 million due to socialist mismanagement and international sanctions. Trump told the executives the U.S. will provide security and protection so they get their money back and make a very nice return. Energy Secretary Chris Wright said the U.S. has taken control of Venezuelan oil exports, and it will hold the proceeds in U.S.-controlled accounts. But here's the challenge. Exxon and Conoco were kicked out of Venezuela in 2007 when Hugo Chavez nationalized their assets. They're owed billions in arbitration awards. They're not going to commit new capital without serious guarantees. Exxon CEO Darren Woods said it plainly. We've had our assets seized there twice. To re-enter a third time would require some pretty significant changes. Treasury Secretary Scott Bessent admitted the big oil companies are hesitant, but said the independent oil companies and individuals, wildcatters, our phones are ringing off the hook. For oil markets, Venezuelan production could add several 100,000 barrels per day in the medium term with relatively small capital investments. This is bearish for oil prices long term, but getting there requires political stability that doesn't exist yet. Now let's talk about the safe havens. Gold closed the week at $4,123 per ounce, up about 3% from last week. Silver is trading at $80.65, back above that psychologically important $80 level after a brief pullback earlier in the week due to Bloomberg index rebalancing. The drivers are everything we've been talking about: Iran instability, Russia escalation, Greenland tensions, central bank buying. China's central bank has been buying gold for 14 consecutive months. Morgan Stanley just raised their long-term gold forecast to $4,800 by Q4 2026. Bank of America says gold deserves a core portfolio role this year, not just as insurance, but as a return driver. JP Morgan and BofA both have $5,000 targets. Silver is the more interesting story right now. It gained 147% last year. Bank of America has targets ranging from $135 to $309 per ounce. Goldman Sachs warned this week about squeeze conditions due to depleted inventories. COMEX inventories are down 70% since 2020, LBMA down 40%. And China's new silver export restrictions went into effect January 1st. Only 44 companies are now approved to export, with an 80-ton minimum production requirement. This is tightening supply at exactly the moment industrial demand for solar panels, EVs, AI data centers is accelerating. Here's my speculation on silver. We're in the early stages of what could be a historic squeeze. Physical premiums are widening. Industrial demand is structural. Investment demand follows price momentum. If silver breaks $85 convincingly, $100 becomes a real target. Bitcoin is trading at about $9,500, essentially range-bound between $89,000 and $95,000 for the past few weeks. What's it waiting for? First, the Supreme Court tariff ruling, now expected Wednesday, January 14th. If the court strikes down Trump's tariffs, that could inject up to $140 billion in liquidity back into the economy through refunds to importers. Risk assets, including Bitcoin, would likely rally. Second, the new Federal Reserve Chair. Jerome Powell's term expires in May. The leading candidates, Kevin Hassett and Kevin Warsh, are expected to be more dovish. A more accommodative Fed is bullish for Bitcoin. Third, regulatory clarity. The Clarity Act, which would create a framework for digital assets, is still working through Congress. Butterfield from CoinShares calls it a persistent overhang that, if resolved, would be a meaningful catalyst. CNBC called XRP the hottest trade of 2026 due to strong ETF inflows. Bernstein maintains their $150,000 target for Bitcoin by year-end and $200,000 by 2027. But here's the bear case. Gold is outperforming as a safe haven. Bloomberg's chief commodity strategist warned that gold's rally could actually be negative for Bitcoin, suggesting money is flowing to traditional hedges rather than crypto. My speculation, Bitcoin needs a catalyst to break out of this range. The Supreme Court ruling Wednesday could be it. Watch the $95,000 level on the upside and $84,000 on the downside. Finally, let's talk about the elephant in the room. How is the stock market hitting all-time highs with all of this chaos? The S&P 500 closed Friday at 6,966, a new record. The Dow hit 49,504, another record. The Nasdaq gained 0.81%. All three major indexes were up over 1% for the first week of 2026. There's actually a market indicator for this. It's called the first 5 days indicator. So when the S&P 500 is up more than 1% in the first 5 trading days of the year, history says the full year finishes higher 83% of the time since 1950. The January barometer is similar. Since 1928, when January is positive, the market finishes the year higher 80% of the time. What's driving this rally? First, rotation. Money is flowing out of mega cap tech and into materials, industrials, financials, and small caps. The Russell 2000 was up 4% this week, massive outperformance. Second, the jobs report. December payrolls came in at 50,000, below the 73,000 expected. Unemployment ticked down to 4.4%. This is the Goldilocks scenario, weak enough to keep rate cut expectations alive, strong enough to avoid recession fears. Third, earnings optimism. Wall Street strategists have an average S&P 500 target of 7,629 for 2026, implying about 11% upside from here. But here's what keeps me cautious. The Shiller P/E ratio is at historically elevated levels, the second highest in 155 years, exceeded only by the dot-com bubble. Valuations are pricing in perfection. And 26% of investors in a recent survey cited an AI crash as their biggest fear for 2026. The market can stay irrational longer than you can stay solvent, but at these valuations, you want to be selective, diversified, and prepared for volatility. So let me tie all of this together. We're watching 3 empires under pressure simultaneously. Iran's theocracy facing its biggest challenge in 47 years. Russia escalating with nuclear-capable weapons as peace talks stall. And the American imperium expanding, Venezuela, Greenland, semiconductor dominance. The money is responding in predictable ways. Safe havens are rallying. Gold, silver. Defense stocks are elevated. Energy is volatile on geopolitical risk. And equities keep grinding higher on liquidity and rotation. But here's what I want you to remember. These aren't separate stories. Iran falls, oil supply disruption. Russia escalates, defense spending increases. Trump pushes Greenland. NATO cohesion weakens. Intel succeeds. American semiconductor independence grows. GM fails on EVs. Oil demand stays stronger longer. Everything is connected. Your job as an investor is to understand those connections and position accordingly. The critical dates to watch: Wednesday, January 14th. Supreme Court tariff ruling. January to 27th, 28. Federal Reserve meeting. 97% chance they hold rates May 2026. New Fed chair expected. Throughout, Iran protests, Russia, Ukraine, Greenland negotiations. Subscribe if you want to stay ahead of these developments. Hit the notification bell. And leave a comment telling me which of these 10 stories you think will have the biggest market impact. I'm filming this on Saturday morning. By the time you watch it, the world may have already changed again. Stay informed, stay diversified, and I'll see you in the next video.